Blue chip stocks are supposed to be the safest names in your portfolio, but when Warren Buffett starts trimming these same positions, sitting on record cash, and avoiding certain giants altogether, that's not random. It's a signal we all need to pay serious attention to. In this video, I'll break down 5 blue chip stocks that show the same warning signs Buffett avoids: stretched valuations, slowing fundamentals, and real downside risk, so you know exactly what to watch for before a collapse. And be sure to stick around because later on in this video, I'll show you a quick and simple way to find the best rated stocks in any industry. By the way, I'm Steve Reitmeister. I spent over a decade as editor-in-chief of Zacks.com, and I'm currently a partner at WallStreetZen.com, where I help develop a quant rating system that helps everyday investors find high-quality stocks without all the noise and nonsense. We ran our screeners to find blue chips that have at least 2 or 4 red flags: a low score on value, lackluster financials, disappointing sentiment, or a low overall score based upon the broad search of their fundamentals. The 5 stocks I'm going to show you today are sitting in millions of portfolios. Most of them are household names, and they might be sitting in your portfolio right now. Most importantly, they are all flashing warning signs that we need to heed. Before we get into it, do me a favor and hit that like button. It tells me that if you like this topic, then I should make more videos like this in the future. Let me be clear about one thing. Buffett is not selling because all blue chips are bad. He's still holding Coca-Cola and American Express. But when the fundamentals deteriorate, he sells. We've seen it with the likes of T-Mobile, Citigroup, and Bank of America. Think about it. It's a dog-eat-dog world out there. When the Oracle Omaha spots a better opportunity, he rots into it quickly without any remorse. However, most retail investors are perfectly fine paying premium prices for the familiar names. The issue is that brand recognition doesn't automatically mean better returns, often quite the opposite. That's the common thread that binds together the 5 stocks we're looking at today. They're all being carried by brand prestige, but when it comes to the quality of their fundamentals, they show glaring weaknesses. Our system has picked up on the factors that Wall Street hasn't fully priced in yet. With that in mind, let's begin. First up, we have Pfizer with the symbol of PFE. There is a version of the Pfizer story that sounds generally compelling. Their non-COVID portfolio actually grew 6% in 2025. Plus, Pfizer has roughly 20 pivotal studies starting in 2026. They made a $10 billion acquisition of an obesity biotech to chase the GLP-1 market, and the dividend is still super attractive at about 6.7%. On top of that, the stock has a B rating for value according to the Zen Ratings quant model. That means it scores in the top 20% based on 21 different valuation measures. That's where the bull case ends. It's all downside from here. Pfizer posted full year 2025 revenue that was lower than 2024, then guided for 2026 revenue to be flat or lower once again. That weak guidance announcement sent the stock falling 5% in a single day. 2 specific headwinds are baked into those numbers right now. COVID product sales and other drugs and vaccines are expected to fall another $1.5 billion year over year. Separately, older drugs losing patent exclusivity cost another $1.5 million. That's $3 billion in guaranteed top-line pressure already built into 2026 before the year has even hit its stride. In all other facets except value, Pfizer is average at best, leading to an overall Zen rating of C, which is equivalent to a hold. But why would you own a hold-rated stock when you could switch into a strong buy or a buy-rated position that is much more likely to outperform? Margins also slipped last year, and debt levels are high, with a debt-to-equity ratio of 1.4, which has shown negligible improvement over the past 5 years. Not surprisingly, with all these operational weaknesses, the average Wall Street fair value target only implies a measly 4% upside for shares. Lastly, Pfizer is ranked in the bottom 4 stocks of the general drug manufacturer industry, meaning there are a lot more stronger stocks in the group. To sum it up, there is no compelling bull case, and there are much better pharma companies flexing real growth that are better choices in your portfolio. Gladly, you can see those better stocks now on WallStreetZen.com by scanning the QR code to see all the higher rated picks in the general pharma industry. Next up, we have Southern Company with a symbol of SO, which is the utility that powers Georgia, Alabama, and Mississippi. This is a textbook definition of a defensive stock. So here's the question that should give you pause. Why is a regulated utility with no growth trading at 24 times earnings? That is a valuation range you normally see on companies with genuine growth ahead of them. Southern Company does not have that, and dividend growth is only running around 2.5% per year, about half the rate of its utility peers. Revenue grew over 10% in 2025. Sounds great, right? But earnings actually fell. The company is taking on significant capital expenditure to expand its grid, and that spending is compressing what flows through to shareholders. All in all, with Southern Company, you're paying a premium for a below average income grower. The proof that shows up in the D grade for growth, implying it's in the bottom 20% of all stocks. Things don't look much better from a value perspective. As I said earlier, it's trading at 24 times earnings, plus the price earnings to growth ratio is 2.1, and it's worse than the industry average when looking at price to value. Adding it all up, it scores in the bottom 30% of all stocks for value. Sentiment is another red flag. Wall Street is not impressed with 3x more hold ratings than buys. It even has a rarely printed strong sell rating on the stock. Price target implies only 1% upside, meaning basically flat in the year ahead. Sure, the underlying business is stable. The demand is reliable. Southern Company is not going anywhere anytime soon, and that is precisely the trap. Investors see a safe business and pay a premium for it without asking what that premium is justified for in the returns. With a yield that trails its peers, a dividend growing at half the industry rate, earnings falling even as revenue climbs, the safety of the business is doing all the work while the investment case quietly falls apart underneath it. If this kind of data-driven analysis is what you are looking for, subscribe and hit the notification bell. We break down the market like this every week. Now, back to that list of 5 blue chips that might have your portfolio singing the blues. Our third stock is Truist Financial with the symbol of TFC, the 7th largest commercial bank in America. They've been buying back their own stock aggressively to the tune of $500 million in Q1 2025. The Southeast footprint gives it exposure to some of the fastest growing population centers in the country. On paper, this is a bank with a real structural advantages. Now here's what the Zen ratings system sees when it looks at Truist growth component. It gives it an F. Yes, a lowly F, putting in the bottom 5%, which is simply unacceptable for any stock in your portfolio. That's because healthy earnings growth is the most compelling reason to own any stock, and it's not in the cards for Truist. Truist also has a return on common equity of only 8%. That is woefully low compared to the 16% average for its banking peers. Not surprisingly, it has a sentiment grade of D, meaning the smart money sees there is something rotten with this stock and thus staying far, far away. With all this fundamental weakness, it will not surprise you that Truist ranks in the bottom 11 out of the 279 stocks in the banking industry. Bottom 11, okay, meaning there are literally hundreds of better stocks to choose from. Before we move on, if you want to see some stocks that are worth a closer look, then grab your copy of my free report, 3 Stocks That Doubled This Year. I'll drop the link to the report in the description below, or just scan the QR code. Moving on to our 4th stock today is Intel with a symbol of, well, you know what Intel's symbol is. There's a generation of investors who grew up with 2 keywords on the computer, Intel inside. That sticker meant something. It meant the most advanced processor money could buy, designed and built by the company that essentially invented the modern microprocessor. At its peak, Intel was the most valuable semiconductor company on the planet, and still the leader in the PC space today. Investors who remember what Intel was are being asked to pay for something the stock that does not currently exist. I'm talking about their long-awaited comeback. In 2025, NVIDIA invested $5 billion in Intel. The U.S. government put in money through the CHIPS Act. SoftBank invested as well. Intel's stock has rallied by more than 1,600% off its 2025 lows. Hooray! This narrative around the stock has generally shifted. There are serious, credible investors making the case for its foundry renaissance. And here's what the Zen rating system sees underneath that narrative. A D for safety. Safety in the Zen ratings model is about consistency and predictability, earning stability, cash flow reliability, how steadily a business performs relative to its peers. A lowly D means the system is saying that this is one of the least predictable businesses in the entire market right now. And the numbers show exactly why. Full year 2025 revenue came in at $52.9 billion. Sounds like a lot, but it's actually Intel's weakest result since 2010. The foundry division, which is the entire basis of the recovery thesis, lost $2.5 billion in Q4 alone. Q1 2026 guidance calls for another sequential revenue decline, margins compressing further, and break-even earnings per share at best. The stock fell 17% the day that guidance came out. The Zen Ratings component grades for both value and growth sits in the bottom third of all stocks we analyze. That kind of makes Intel a non-starter investment at this time. The NVIDIA, SoftBank, and U.S. government investment in Intel is certainly interesting, and perhaps worthwhile putting Intel on your watch list if the fundamentals in Zen Ratings ever improve. Until then, there are many semiconductors with more compelling investing stories. The last stock on our list today is Boeing, with a symbol of BA. I want to be honest with you about Boeing, because it might be the most complicated stock on our list today. In the plus column, Boeing scores a Zen rating of B for growth as well as safety. Those are some of the strongest component grades of any stock we have covered today, and they reflect something quite positive for us to consider. Also in the bullish camp is a burgeoning commercial backlog of $567 billion, the fact that it's the only major U.S. commercial aircraft manufacturer and earnings forecast to grow at twice the pace of the industry, and defense contracts that don't go away in a downturn. Now, the system is not pessimistic about what Boeing is. It is cautious about what you are paying for it. Value is only a C based upon our review of 21 different value measures. Financials and sentiment are also subpar C grades. This certainly adds more tarnish to this formerly coveted blue chip. Here's where things actually stand. Free cash flow turned positive in Q3 of 2025. The 737 MAX production rate is climbing. Those are real milestones that deserve to be acknowledged. But as for the 777X, just got pushed back again, this time to 2027. The program has already absorbed nearly $10 billion in additional charges. The 737 MAX 7 and MAX 10 are still not FAA certified. On top of that, the company carries a massive, and get ready for it, $53 billion in debt. The Boeing bulls told this recovery story was taking place in 2023. And then again in 2024. They were not wrong about the direction. They were wrong about the timeline again and again and again. The B grades on growth and safety tell you that this company has a future. The C grades on value and financials tells you the current price they're asking you to pay for the future has not arrived yet. And the C on sentiment tells you the smart money isn't scaling into this stock, and neither should you. A serious pullback might change that math, but right now it does not add up. There you have it. 5 blue chips, 5 reputations that feel safer than the fundamental data says they should be. None of these companies are filing for Chapter 11 anytime soon, and some might have a bright future much further down the line. But in the here and now, they are not compelling investment choices. Here's what to do with all this. Pull up any of these names on our free quote pages on WallStreetZen.com to see exactly what the Zen Ratings model says. And if you're holding, ask yourself one honest question. Am I holding this stock because the data supports it, or because the name feels safe? Those are two very different reasons, and only one of them proves financially beneficial over time. Gladly, we have given you resources to find much better stocks in the same industries. Drop a comment below and let me know your take on this stock list, or perhaps you want to share other blue chips that you would advise your fellow investors to drop or avoid. I read all the comments, and I really like to see a discussion come alive below this video. And if you want to skip past the same old names and discover 7 excellent stocks that all rank higher than NVIDIA based upon their stellar fundamentals, then be sure to check out this video.